The floor just got pulled from under the bulls without price moving an inch. Bitcoin is stationary, but the volatility curve is screaming. The asset is coiling between 80,900 and 81,560, and the 1-hour squeeze we are seeing right now is the tightest compression in days. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end because I am giving out 3 exact entry and exit levels you can use right now, including a high-risk aggressor play that targets the liquidity above the range. Here is your instant market verdict. The session bias is fading the breakout until proven otherwise. While the daily trend is technically listed as bullish, we are treating this as a false break environment on the lower timeframes. The one invalidation level that proves this bias wrong is 82,042. Write this number down. If we get a decisive 4H candle close above 82,042 with rising delta, the whole structure shifts from a trap to a true trend continuation. Until that happens, I am looking for exhaustion above the $81,550 mid-range. Let's dive deep into the technicals. Starting with the weekly chart, we are still holding above the 20-week moving average, which is absolutely critical. This level is the institutional reload zone. However, look at the velocity. We had that explosive leg higher, but now we are compressing below the high. The 200-week moving average is far below, acting as a distant floor, but right now, the weekly structure is simply a consolidation flag. A flag that is coiling right towards the apex, dropping down to the daily timeframe. This is where the narrative gets dangerous for late longs. The 20-day moving average is sloping up, providing dynamic support near that 80,185 level I flagged. The 60-day average is also rising. The 200-day average is sitting right here, acting like a brick wall confirming the macro trend, but we are heavily extended above it. The MACD on the daily is still printing positive ticks, but the histogram bars are shrinking. This is the early warning sign of momentum exhaustion. Buyers are struggling to push through that thin air above 81,900 now. Let's zoom into the 4-hour and 60-minute charts because this is where the money is made today. On the 4H, we have a textbook structure. Price is making a series of minor highs, but the 4H MACD is starting to roll over. We are seeing the inkling of a negative divergence. It hasn't fully confirmed yet, but the signal is clear. Momentum is waning while price is elevated. The 20-period moving average on the 4H is flatlining at 81,550. The 60-period on the 4H is acting as the lower boundary of the compression. We are literally squeezed between the 4H 20 MA and the psychological 82,000 resistance. A squeeze of this nature never ends calmly. It explodes. The critical support to watch is the zone between 80,185 and 79,693. That lower band is the line in the sand for the daily trend structure. If we break below 79,693, the bull flag invalidates. And we likely see a violent liquidation cascade to fill the CME gap below. The resistance is obviously 82,042. There is a massive pool of short liquidations building right above that level. Market makers can smell it. Here is what most traders miss. I need to bring in the S&P 500 risk asset shadow correlation right now. Look at the ES futures. Equities are running on that liquidity tide, but Bitcoin has stopped tracking. We have a divergence where the S&P is pushing session highs, yet Bitcoin is struggling at its range high. This is a classic risk asset fracture. If Bitcoin cannot catch a bid while the S&P 500 rallies, it tells us there is stealth distribution happening. Always watch the divergence. The market leader, Bitcoin, is showing relative weakness against the liquidity tide. That is a caution flag unless instantly remedied. Let's connect the fundamental driver. The 24-hour news flow highlights Bitcoin coiling between 80,900 and 81,560 in this 1-hour squeeze. There is no single macro catalyst, but look at the ETF flow data. We are seeing a slowdown in net inflows. Not outflows yet, but the aggression on the bid has vanished. Funding rates are slightly positive but not excessively so, which means retail is cautiously long, but the basis trade is unwinding. If we do sweep above $82,042 and funding rates spike above 0.05%, the trap is loaded. That would be a classic stop-loss hunt on early shorts and a trap for breakout chasers before the reversal. The 1 to 2 week directional lean is cautiously bullish to neutral, but only if 80,185 holds. The exact event that would invalidate this thesis is a daily close below 79,693. That level is the pivot. That would confirm the divergence on the 4H and suggest we dive back into the range lows. Most people will skip this segment, but this is exactly where the money is made. Keep watching. I am going to give you the 3 specific strategies with exact price triggers. Strategy 1, the sniper. This is the conservative play. We are waiting for a deception. The trigger condition is a sweep of the 82,042 high followed by a swift rejection wick on the 15-minute chart. We do not short the high tick. We wait for the price to break above, trap the longs, and then collapse back below 81,700. That is the entry trigger. A strong sell candle closing below 81,700 after sweeping 82,042 is your entry. The stop loss goes above the sweep wick, around 82,250. That is a tight stop. Target 1 is the 4H20 MA at 81,550. Target 2 is the bottom of the congestion at 80,900. This gives you a risk-reward ratio of roughly 1 to 2.5. What voids this? If we break 82,042 and consolidate above it on the 15-minute chart without rejecting, do not short. The sniper only shoots when the prey steps into the trap. Strategy 2, the active trader. This is the standard mean reversion play. The entry condition relies on a pullback. We use a limit order at the 80,185 support zone. This is a bid in the value area based on the daily 20 MA and prior. Structure. The stop-loss placement reasoning is simple. We place the stop at 79,600, right below the 79,693 invalidation point. If support breaks, we are out with a small defined loss. Target 1 is the mid-range at 81,300. Target 2 is the range high retest at 81,900. The trailing stop rule here is critical. Once target 1 hits at 81,300, move your stop loss to entry. This is a free trade. Let's see how aligned we are. Type your Bitcoin range for tomorrow in the comments right now. Is it 80,000 to 82,000? Or do we finally break? I am reading them. Tell me your bias. Strategy 3, the aggressor. This is the countertrend or momentum chase. Only for those who know how to lose small. You are looking for an impulse break above 82,042 with a 5-minute candle close and a bullish MACD cross on the 1 minute. If that confirms, you chase entry with a market order. Stop loss is extremely tight at 81,850. You are risking a small amount to catch a violent short squeeze. Target 1 is 82,500. Target 2 is 83,000. This attempts to surf the liquidation cascade. Do not try this without a hard stop. If the market snaps back, you will get hurt if you hesitate. Time for the risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like CPI tomorrow. Stops are non-negotiable. You move them to entry. You never delete them. Here is your close. The most critical level for the next session remains $80,185. If that gives way, the bullish structure is deeply compromised. Tomorrow I am focusing on the CPI print and its direct impact on this correlation breakdown between Bitcoin and the S&P 500. If you want the full breakdown on gold and oil reacting to the same macro event, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage. I will see you in the next one.